right, I'm with Adriano today. He has $215,000 in MST at $14.91 per share. I have $193,000 in MSTE at $11.78 per share. He gets $6,500 in distributions a month. I get $7,400 a month in distributions. We get less now, Adriano, because they went from 55 cents to 45 cents. The stock has dropped from $14 to, who knows, $10 and something. I don't even know what the price is right now. I get tons of comments. I put out that video last week. That's why I reached out to you saying, hey, I just bought 200,000. And then I got shit on a lot. And I said, let's answer some of those questions.
So in terms of percentages, MST is my biggest portion. So it represents 9.71 of the portfolio, HBTE 8.14, and HBIX, just the Bitcoin, is 5.42. So I came out with the numbers just because I knew you were going to ask me this. So for the MSTE investment, in terms of unrealized capital loss, keep in mind this is unrealized, right? I'm currently down 57,000, but I made since inception $42,300 of income from it. So that means I'm down what, I don't know, 15 or 13,000. HBTE, I'm up 122,000, and I made $11,000 worth of income. And HBIX, just the Bitcoin, I'm up 5,000 right now, and I made 7,300. So overall, if you look at the overall, I'm way up on my Bitcoin positions. So if you want to talk about why I invested in MSTE, well, it's the only single stock I have in my portfolio. Probably the only single stock I will ever have in my portfolio. But I just have conviction in it. I'm a big fan of Michael Saylor. I've watched a lot of his podcasts. I'm very grateful to him because I learned a lot of stuff about the overall monetary system and the fiat system. I learned a lot from him, and I saw him on with Jordan Peterson and all kinds of podcasts on PBD. He's a very smart guy. I mean, the guy's a rocket scientist. He went to MIT, et cetera, et cetera. So I'm a big fan. I like his style. I have conviction in strategy and what they're doing. So you should only be investing in a single company, in a single stock, if you actually know what the company's all about. That's my opinion. So I look at the strategy dashboard every day. I'm kind of obsessed with it. That's where I go look for the Bitcoin price. I look at the MNAV all the time. And Bitcoin's been relatively okay, pretty sideways lately, still pretty strong, not at the all-time high as at 125,000 or whatever. Now today it's at 115. But the MNAV has been shrinking on the stock, which means it's still trading at a 1.33 MNAV, means its strategy's market cap is 33%. It's in relation to the value of its Bitcoin, right? So you could say it's trading in relation to its Bitcoin holdings at a 33% premium. So I kind of think of closed-end funds, kind of. So I've seen it at 1.4, 1.5, 1.6. At one point, it's been over 2, over 3. It's actually the cheapest MNAV I've ever seen it. So in my opinion, it's getting more and more undervalued in relation to its Bitcoin holdings. But in terms of your question of why I hold it, I just have conviction in it. And another reason is I consider my portfolio actually pretty boring. This is the only fun thing I have. It's the only fun that I have, an excitement I get from my portfolio. I don't get it from the Bitcoin and holding things like QQCL and HYLD, NASDAQ 100 and S&P 500. And that's the point. It's not supposed to be exciting, right? Those are anchors. Yeah. This is only really the fun position I have. I don't see myself ever going over 10% of my entire portfolio. Right now, it's at 9.71. Now, of course, there's HHIS, there's Biggie now, which has a strategy inside of it as well. And it's also an HBTE. So I'm just going to keep going. I'm going to keep averaging it down. I have long-term conviction. I have, 10-year conviction on this thing. We'll see what happens.
So you're taking your monthly distributions from MSTE, buying more into it? Because, I noticed I check you can go to his website, it's called passiveincomeinvesting.com or .ca.
.ca, yeah.
.ca. You post your every month you update. So every month I just check, see what you're holding. And I've noticed that your average cost per share has been going down for that. So I was like, I guess he's just reinvesting.
Yeah, because I've been buying more cheaper shares, right? Yeah. It's only normal. Yeah.
10% of your portfolio. So yeah, this is definitely less than 10% of my portfolio, but I'm not, but this is my overall portfolio. I'm not covered call focused per se though. Like I'm kind of like a boring index. I'm the boring version of you, but for index investing, and individual stocks. But
Yeah.
this is like 90% of my covered call portion of my portfolio. This is like it all. And I want to explain rationale. Let's just talk about it. People say they're like, hey, you're overexposed in this. Here's a couple things they need to understand about me to preface this. I'm not overexposed. I hold a shit ton of VFV and individuals. So I own a freakish amount where this is not my portfolio. This is just what I show you on Blossom and other things because this is what I talk about a lot because it's the funnest stuff to talk about. I really like income investing. I'm new to it. After talking to you, it's sort of what gets me jazzed up. So that's that. Secondly, I'm also underexposed in crypto. This is my only crypto exposure, literally. So I'm underexposed in covered calls in general. I'm underexposed in crypto in general. I just happen to have crypto covered call as my main position. So it just gives me that like percentage exposure in my overall portfolio. So it looks overexposed, but it's kind of not in my overall grand scheme of things. So that's that. Um, a couple of things for MSTE. I will eventually start trimming this position down if it hits, and not. I originally was like, hey, I'm going to sell it and make this like a short-term trade and like swap it. But you mentioned something when we first spoke of like, do you have the stomach for it? I was like, all right, I bought it and immediately dropped $1 and distribution dropped, and I didn't care. I was like, okay. I was like, oh, I guess I have the stomach for it. It didn't bother me at all. Like I went to Hawaii. I just got back a couple
Mm-hmm.
days ago. I went on a Hawaii trip and had a great time. I didn't even think about it. Came back, didn't think about it. So I was like, oh, it kind of doesn't bother me as much as I thought it would to hold this type of covered call ETF, single stock, crypto attached to MicroStrategy. So I'm actually going to be selling again. I will sell when it hits a certain price to trim, but only to buy more of HBTE. I like having this as my main crypto exposure. I like having a supercharged crypto cover call ETF as like that's a portion of my portfolio. But I just felt like, okay, well, I just kind of want to split it now between different type of crypto. So I'm just going to take some
Yeah.
MSTE and buy HBTE. What do you think of that?
No, I think first of all, at the beginning you said some people are you got comments that you're overexposed or you have too much exposure. I love getting comments how people are judging other people's portfolios. There's actually a lot of
Mm,
that going on lately. And my
yeah,
opinion is who are you to judge what my exposure is or what I feel is best for my
yeah,
portfolio? Like I mean who are you exactly?
yeah,
It just
yeah.
makes me laugh how people judge other people's portfolios and investing styles. And I mean, why? What's your point? You do you, I'll do me, and that's it, right? So I find that very comical. But I mean, exposure, even risk. I mean, risk is in the eye of the beholder, right? If you talk to a Bitcoiner, if you talk to a Bitcoin maximalist, he would say that you're underexposed or
Yeah.
that it's risky not to have 100% in Bitcoin or
Mm-hmm.
90% in Bitcoin, right? Then you talk to a someone else traditional or someone who has no idea. Oh, it's too risky. It's very risky. So risk is in the eye of the beholder. Everyone has to make those decisions for themselves. And, everyone has their own style of investing and you want to go all cover calls, you want to go half, you want to do a little portion, you hate cover calls. That's fine. I'm not judging. You shouldn't judge other people's portfolios. So, that's the first thing I want to say. The second thing I want to say is you said you went to Hawaii, it dropped $1, it didn't bother you, right? Why didn't it bother you?
Well, first of all, I know a lot about MicroStrategy. I actually believe in the underlying asset, and I have a couple theories. I actually think MicroStrategy can join the S&P 500 one day. I actually
That's
think,
a probability. Yeah. Don't know
and I
when,
think
but
we don't know when, and I think there might be some because I think they met all the requirements. It's just like a political like, hey, do we just let him in now, like into the
yeah.
boys club type of thing. I think that's where it's at, which is, and I think things are inevitable, and I think that's gonna actually stabilize pricing for MicroStrategy, where it'll just be like, oh, everybody's gonna have to buy, like institutions will have to buy a certain amount to have it part of their index funds.
So first of all, let's just talk about MSTE and what it is.
Mm.
So just the fact that someone says the distributions are going to go to zero means they have no idea what they're talking about. They don't know what MSTE is, what it does, what cover calls are. So MSTE is an ETF that all it holds is MSTR. That's it. With 25% leverage, so you could say it has 125% exposure to MSTR. And they're writing covered calls on about 33 to max 50% of the portfolio. And that's where your distributions come from. So there's always going to be distributions. They could vary. If the price keeps going down and down and down, the distributions are going to have to go down. But if the opposite is true, the opposite could happen as well. The distributions are going to go up if the NAV keeps going up and up and up like it has, right? It started at 60 cents and then went to 66, then 55, and now 45. I was actually expecting a distribution reduction. I thought it would be more than just 10 cents. But if you understand what you're investing in, if you understand cover calls, you would actually be worried if they didn't cut the distribution, because they're taking in less premiums most likely now because the NAV went down. But anyway, that's just MSTE. So distributions are always going to exist if MSTR stock is always going to exist, period, right? Options market, we don't have to get into that. It's just how it is. In terms of how low it could go, I don't know. Maybe it'll go much lower. Maybe tomorrow, next week, it'll go up 10, 15%. We've seen some crazy moves with MSTR. I do agree with you that I think a lot of people, including traditional rating agencies, which I heard he just got a rating today of a B minus, and apparently they excluded the Bitcoin that MSTR holds, which is just telling you how underrated and how unknown what he's doing. It's a very novel idea what he's come out with. So I think it's very, very, very early with this type of company, this type of strategy, Bitcoin treasury company. Is it going to outperform Bitcoin long term? That's the goal. Is it doing that now? In the short term, no. But if you go back since they started accumulating Bitcoin, I think it's still way, way ahead of Bitcoin in terms of total return. Don't quote me on that. But yeah, MSTE. Let's forget about MSTE. It's MSTR. If you have a stock, so in the cover call space, what I've noticed after a lot of experience and watching is that if you have a basket of stocks, an index, one stock, whatever it is, with covered calls, let's say max 50% of the portfolio. Harvest typically does 33%, but they could go a bit higher. With 25% leverage, there's a reason why most Canadian fund managers chose that amount. It's going to have very similar performance to just holding MSTR. So for everyone needs to forget about MSTE. You're really investing in MSTR. They're just doing covered calls on it. Now the distribution, here's another thing to understand. The distribution, so whether it's 45 cents, 55 cents, zero, which it won't be zero, but let's say they drop it to 1 cent or 10 cents, or they jack it up to $1. That's just a measure of how much of the net asset value of the ETF they're giving out to you in cash.
Yep.
So if it goes to 45 cents or 35 cents or 25 cents, it actually does not impact the total return of the ETF itself. It only impacts how much cash you're getting. Think of it like, I'm just going to buy VFV. I'm going to sell 1% of it every month. I'm going to sell 2% of it every month, right? It's just a measure of how much of the net asset value you're selling. Well, Harvest is kind of doing all that for you. They're taking care of that for you. They're giving out what they can without giving out more than what the fund earns. That's typically what they do. And that's why I have a lot of confidence when I see a reduction, and I would have been worried if I don't see a reduction, right?
Yeah.
Does that make sense?
Yes, and that's how I perceived it, because I had a lot of comments being like, what are you going to do? The price is going down. What happens if their distribution? And my thing was like, I hope. You got to protect. You got to protect the actual ETF. If they kept the distributions high and it was going down, then I'd be like, we're in some sketchy territory here. But I was like, no, they're protecting the ETF. They're taking care of it. They're not like
what they're doing is
like
essentially not giving out more than they earn. So MSTR does not have a dividend, everyone. So MSTE or there's a million of them now. Any strategy ETF with covered calls, there's so many of them in the US, there's a million of them. There's no dividend. All the income, 100% of the income is covered call premiums. So covered call premiums will always exist. So it's not a dividend stock where, Bell Canada or dividend stock cuts its dividend by half. That's because the company's in trouble. It means dividend is actually profit, a share of the profit of the company. So if they cut it, well, we're making less profit. Company's not doing as well. The premiums on or the dividends from these covered call strategies, especially on MSTR, which has no dividend, is solely based on the premiums that they're making, which is based on two things: volatility, which is why everyone was attracted to this ETF in the first place, because it has really, really, really high yield. Why? Because it's a very, very, very volatile stock. So the premiums are very, very rich that they're taking in. But when volatility starts going down, like it has been for Bitcoin in general and MSTR as well, it's been ticking up a little bit, but it's already tapered off. They're taking in less premiums. If the NAV continuously goes up and up and up, they could probably sustain it because they're taking in more premiums because the net asset value is going up, but it counterbalances the drop in volatility. But when volatility drops and the NAV goes down, they have to cut it. It just shows responsibility of the fund manager, right? So I trust Harvest. I know they're very, very, very responsible. They don't want to pay out more than the fund earns. But whether it's 45 cents, 35 cents, it just means on X dividend date, the stock, instead of dropping 55 cents, is going to drop 45 cents. Instead of 45 cents, let's say they drop it again to 35 cents, which they could very well do if MSTR keeps going down and volatility stays the same or goes down. It's going to go to 40, it's going to go to 35. It just means that they're giving out less and less of the NAV to you. So for example, if you have MSTE on drip, whether you get 55, 35, 45, it doesn't make it, the total return remains the same. If MSTE, let's say they're not going to do this, they just stop giving out the dividend, they just cancel the distribution, well, there's no ex-dividend date, so they're not giving out 45 cents or 35 cents. That's just staying in the fund, right? So this is why I don't get panicked, or I don't care of a distribution reduction or an increase. It just means more of the NAV is being given out to you. If they would leave the dividend alone, well, you'll see the capital in your account go up higher, right? It's all part of the net asset value. Am I making sense?
Yeah, I'm going to simplify it a lot now. I'm going to simplify it in even more. What happens is they cut the distributions, because what happens is they don't cut the distributions, they're eating into the actual price, like the actual NAV, the actual price. They're selling it off to meet your requirement of like, hey, I got to give you this 55 cents. They're like, we don't want to do that. We don't want to sell it off and lower the NAV. We're just going to give you less and then not have to sell anything off. And that way we can maintain that core. That's why when you say the actual capital return is the same, that's why. Now there's a couple of different things here. Do you even always want to have an increase in distribution? Because you have to weigh it. Because you're looking at overall return, they write covered calls on 33 to 50% at their discretion. If MicroStrategy goes on this crazy run and just skyrockets, I don't want them to be like, bring it up to $1. I want them to be like, no, we're only going to write on 33% because we want to let this thing run a bit. Let's just let it go up. They're using their discretion to do that. You're always trying to have your cake and eat it too when possible. If there's all that, capture that upside if you can, while giving out people's expected returns. But when things are looking bad on both fronts, low volatility, so you can't get premiums, and also no NAV growth, you have to make a concession somewhere. And it's really just like, okay, you just get less monthly distributions, because we don't want this to shrivel away. Distribution cut, all it meant was, oh, thank God they're protecting the NAV. That's all I thought. I was like, they're not being... That's a good way to think
about it.
Yeah, I did. They're not folding under pressure. They're trying to give people short-term impulse dopamine hits of like, give me that money. They're like, no. And which means I feel like they're looking at it long-term. They're looking at, how do we sustain this? That's what I was looking at. So I guess that's why it doesn't bother me. The price fluctuation doesn't bother me, because I've been investing forever. I know what I invested in before I started. I knew this was going to happen. In my video, I said, yeah, I could get down to like $9 or whatever. Okay.
Or more.
Like, I won't really, or more, but I'll just, as an example, be like, I don't really care. Like, that's not what I'm in it for. And then, after holding the position, I was like, God, I really have a stomach for this. I became more committed because I thought I had more of some sort of adverse reaction. I was like, oh, I'm fine with this. Only thing I felt was like, kind of wish I had more diverse crypto exposure. Okay, great. I want to get HBT. That's how I felt about it.
What you said is right. I mean, HBTE is a good alternative. So I came out with a video because I also got a lot of comments, and I was in Toronto lately, and a lot of people came up to me and asked about MSTE. And I won't even say MSTE anymore. We're going to say MSTR because that's basically what it is. And I told them, well, listen, why did you invest in this in the first place? Is it because you just saw that 40, 50% yield? That is the epitome of the biggest mistake beginner income investors make. You have to have conviction in what you're investing in. I researched and looked at the latest. I saw the 2-hour Q2 presentation of MSTR. I've watched a million podcasts. I know about their prefs. I know what their long-term vision is. I know Michael Saylor is dead fast. They're deadlocked. We're just going to keep buying more Bitcoin and borrowing, right? That's all they're doing is arbitraging fiat currency with Bitcoin. That's the strategy long term.
I want to run something by you though, because I have you. You have a really U.S. heavy portfolio. You're across TFSA. You're across your non-reg and stuff. But my registered accounts are mainly, like I told you, like growth and all that kind of stuff. But my non-reg is covered calls. I don't have like QQCL and any of these other ones, but I do have. I was thinking for my MSTE, my future HBTE distributions, I was going to buy them when they're under my buy-in price. Like whenever they're like, if my average price per share is $12, I'm always going to buy it when it dips below. Just keep buying it. Whenever it goes over, I was going to buy into HDiv and Bank, the two Canadian ones, and just on the side pot start building up my positions. So I was just going to build a feeder position where, like, all right, when they're above, and then only when do they go to some ridiculous amount above, like ridiculous, I go, oh, I'll trim it a bit, and then I'll basically do something with it. I'll either buy more into like HBIT or more into MSC, whatever,
Yeah,
lower value or more. And that was it. I'm literally just feeding 4 positions. It was MSC, HBT, HDiv, and Bank, and they're just kind of interweaving when it makes the most sense. What do you think of that? It's very simple. It's only 4. And that's my non-reg in a nutshell. What do you think of that?
I think if it works for you and you're comfortable with that, that's fantastic. I'm happy for you. There is literally, my friend Gary, a billion ways to manage your portfolio. When you have an income focused portfolio, you have a lot of options. When you have a growth focused portfolio, and I think growth index funds, fantastic way to invest long term. It works, classic, great. When you're an income heavier investor, you have a lot more options, right? You described I call it the feeder option, right? You're taking dividends from one.
That's my note. It says feeder. It says feeder on the note. Yeah.
You people turn the drip on. Some people, one account is going to be income and the TFSA. There's literally a billion combination in ways to manage your portfolio. And this is a very common question I get from newer income investors who are overwhelmed by this. But you could use the income, for example, like you said, if you're maybe a little bit too high on MSTE, you want to go with more HBTE. You don't have to start selling or trimming, but you could start taking those dividends or those distributions, which are literally part of your MST net asset value, your MST investment, and put it in something else. And eventually your percentages will go a little bit higher in HBTE or HDiv or Bank and a bit lower in MST. And you could kind of manage your portfolio that way in terms of percentages, right? It's all about choosing the percentages and the funds that you're most comfortable with. If you want to invest in MSTE, I hope you have conviction and believe in Bitcoin. If you don't believe in Bitcoin or think it's a scam or it's going to go to zero like a lot of people still do, why the heck are you investing in MSTE or HBTE or IBIT, right? It's about the convictions. If you have convictions in the Canadian banks, a lot of people do, right? That's why you would invest in the bank ETF or HDiv, which is like 38% Canadian banks, right? So you have to have the convictions. Like you said before, I'm very, very heavy on US, which is very, very concentrated in tech. And I have QDay, I have QQCL, which is even more concentrated in tech, right? So I have that conviction. I worked in the tech field. I see that not only all the returns from the stock market are coming from the US tech sector, most of them, but I believe in the technology going forward. It's going to be the most important thing in the next 5, 10, 15 years, right? It's all about long-term conviction as an investor. In terms of what you're doing in your portfolio, it's going to work great because that's what makes you feel comfortable and what makes you sleep at night. So there's no right or wrong when it comes to investing, in my opinion. Even though you have a lot of nincompoops on Blossom, for example, who think their way is the best way and this way is wrong, or look, investing in covered call ETFs are wrong, right? Who are they to judge how I invest or how I live my life? You know what I mean? So I think it's a good idea. I think HBTE, and I actually made a video on MSTE. And look, if you don't have the conviction in strategy or you think it's too risky, you got plenty of other options. HBTE is a great one because you have, in my opinion, it's the least risky of, strategy, just Bitcoin, and HBTE. I feel HBTE is the least risky because in there you
Definitely.
have Block, you have Coinbase, you have Galaxy, Riot. Yes, they're Iron, which is like data center, cloud, whatever. So yes, it's kind of associated with Bitcoin, but they have other businesses, right? They have other stuff. So maybe that's a better option for you. So it's all about figuring out the option that makes you feel the most comfortable. And single stock investing is the highest risk of investing, right? So strategy, MSTE, reduce the distribution by 10 cents. HBTE more than doubled, increase the distribution 10 cents, right? I'm doing really, really well on HBTE. I have a small unrealized loss if you count the income on MSTE. Maybe next month it's going to change. Maybe next year it's going to change, right?
Yeah.
So for me, it's like my PIA portfolio is just so boring for me that I got to have something fun or one stock that I really, I used to have Tesla, and then I said, you know what, Tesla's everywhere. It's in the S&P, it's in the NASDAQ. MSTR, I think, is still very, very much underappreciated, underrated, undervalued, and I see the MNAV is just shrinking. Today's a perfect example where it's more undervalued because you have Bitcoin up 1%, you have MSTR down 1.6%. So the MNAV is now 1.33. This morning when I checked, it was 1.35. It just means you're getting more bang for your buck. And in terms of the future, yes, they're accumulating Bitcoin. They're always going to be the number one Bitcoin treasury company now because no one's ever going to catch them. They have over almost 641,000. Who knows what they're going to be able to do with that Bitcoin? Already they're
That's
offering
the
the
thing.
preferred. What if they become a bank? They could literally become like a central bank.
That's
So
that's what I
I'm
think
betting
is going to
on
happen.
the excitement of the future, just like a lot of people are doing the same thing for Tesla. I met
Yeah.
a woman last week. I did a testimonial with her. She has a strong conviction in Tesla going forward. She doesn't think Tesla's a car company. If you think Tesla is just a car company, you don't have
Yeah.
conviction in Tesla.
Yeah.
But some people do. They get excited on what it could become. So that for me is strategy, right? I have that excitement, that conviction. And let's just say it goes to zero, I'll be okay. I'll be
Yeah.
fine. I'm still a very responsible investor. It's probably not going to be more than 10% of my portfolio. And if I lose that $215,000, it goes to zero. Well, so be it. That's just the risk that could happen when you're investing in a single stock, right? It's possible.
That's the question I've gotten so many times. Like, what happens if it goes to zero, distributions go to zero, this thing tanks? What are you going to do then? I said,
Well,
eat the
Bitcoin
loss
has
and
to go to zero for MSTR to
that's,
go to zero. That's number
I know, but
one,
you
right?
know how people do. Like, they just throw it out there. But even in that, let's say everything goes to zero. I eat the loss and I move on because I could afford it in the first place. I didn't do it. I didn't over leverage myself with this move, right?
Exactly.
If it was $5,000 was most responsible, I do 5,000. If it was 1,000, I would have done 1,000. This just happened to be the number. I was like, all right, cool. This is what I got available for this exact type of play. Let's do it. I go in. If it went down to zero distributions, then you just own leveraged MicroStrategy. That's all. Like that's like
Well,
essentially that's all it is.
that's
Is it?
impossible because
Yeah.
it would mean that there's no more options market.
Yeah,
You know what I mean? Like it's
yeah,
impossible that they could get reduced, they could
yeah.
increase. There's always going to be option premiums to be had. So anyone who says the distribution is going to go to zero just doesn't know what they're talking about with these strategies, right? Bell stock dividend could go to zero if it becomes an unprofitable company, or a dividend stock could reduce the dividend completely. That could happen if they're no longer making profits. Actually, they should do that, right? Why give out profits if you don't have any? But this is not dividends. This is not profits. This is just call premiums. So
What?
call premiums are always going to exist as long as the stock is trading. Could they vary up or down? Yes, that varies on volatility. But you know, you probably seen a bunch of Michael Saylor videos. They want the volatility. That's the whole point. So I expect
Yeah.
it to remain a highly volatile stock, slightly higher than Bitcoin itself. Just like gold miners or gold producers are always slightly higher volatility than gold itself. Right? I recently added some gold exposure to my portfolio, 2.5%, but
Yeah.
gold is just so boring. There's like barely any volatility, so I added GLCL, for example, which are gold miners with covered calls and 25% leverage. I need to have that format, or else I'm not really interested.
Yeah. Yeah.
Um, so, that's a little bit of a, old gold versus the new digital gold. I'm still going to be much more biased versus more conviction with Bitcoin because I feel it's just a superior technology. It solves a lot of the problems that gold has, physical gold has, with the storage and how much is there of this stuff. Like maybe someone has found a crap ton, they didn't say anything, they announce it, gold prices drop. What if they figure out how to create gold synthetically? What, you think they won't be able to do that in 50 years, 100 years? I
Yeah.
don't know. They do it with diamonds, they can't do it with gold. You just
They.
never know. Bitcoin is special because there's a hard cap
Yeah.
and nobody could control it. There could be whales that could do big purchases and dumps, but no one really controls it. Gold is, all kinds of manipulation, and banks have been fined by manipulating the prices and they suppress it. And Bitcoin, nobody can really control it. You could talk crap about it. Jamie Dimon could talk crap about it and say how it's crappy, it's crappy, it's crappy. In my head, I'm like, this guy's secretly buying Bitcoin. If you want to if you know something is going to go up and you want to suppress the
Yeah.
price, you should talk crap about it. Like, I don't know how people don't realize that, but anyway, now we're going down kind of conspiracy stuff, but I'm a
I think.
long-term bull on Bitcoin because I understand that it's a powerful technology. And Michael Saylor, who kind of predicted and called the Mag 7, you even wrote a book about it, that these companies are going to be the dominant companies. He was right. He was
Yeah.
right. So I think he's probably right about this too.
The world's changing really fast. Bitcoin is part of that change, and that's what I had to
Hmm.
learn. I had
Yeah.
to kind of take my old man hat off and go, wait a second. Even the younger kids, this is what they know. Like the people inheriting the world, it's the Bitcoin world they're going to inherit. It's not going to
That's another
be.
good point we could talk about.
Yeah.
Right. Sorry, I'm chewing
Yeah.
ice here.
No, no worries.
But you've
You have to
you've
consider
heard of
that
that?
though.
That sorry, I don't mean to interrupt you. There's a delay.
Yeah.
Um, but there's going to be a big wealth transfer coming in the next 5-10 years, right? Where the boomers are going to
Mhm.
transfer their wealth to the millennials. If you do polls, boomers don't know anything about Bitcoin. They don't believe in it. It's completely normal. It's not a shocker. The younger you go, the more people understand it and believe in it. So when
Yeah.
the wealth transfer starts going from the boomers to the millennials and then to the Gen Zers, it's only going to fuel more buying, I feel, and more.
Millennials are the transition phase. When it hits Gen Z, it's over. That's when it's like they'll like that's all they know. They born into a world like that, right? And even younger. It's like I said, long time horizon. I'm looking at that.
Yeah.
I'm going, oh, if I don't, I'm actually not late. You know, some people say I was late to crypto. I don't think I'm late. I still
No,
don't
I
think
think
I'm
we're
late.
still
And
early,
yeah,
my
exactly. I'm
opinion.
like, I think I'm early by I think even a decade, to be honest. Like I just like
Yeah.
the thing. It's gonna be like the world my kids live in. I got a 2 and 3 year old. It's going to be a digital everything world. Let's answer a couple questions. First,
Yeah,
I want to
sure.
touch on a couple things you said. First was, I'm going to go back to different ways to do a portfolio. There's no wrong or right way. Thank you for putting emphasis on that. People all the time online, like you're doing it wrong, you're doing it wrong. I'm like, first off, maybe with index investing, like normal ETFs, it is kind of very more one dimensional. Buy VFE, buy XEQT, forget about it. Like there's not a whole lot. But with income investing, at least my experience,
Mm-hmm.
every portfolio is highly personalized, no matter what. You actually cannot copy and paste anything anyone does because every decision I've made has been hyper personalized to everything from what I currently have in my portfolio to my psychological profile to different things that, like, it is so nuanced that I actually can't recommend my portfolio to anybody because it's purely dialed in for Gary Gill. That's it. Like, why did I want to do HDIV and why did I want to do bank? It's, there's some tax benefits for non-reg because if you're Canadian, right? But that's whatever. It's offset by higher yield ones. But for me, it was, I'm like you, I'm US heavy and I'm tech heavy. I have so much exposure to that in my other portion of my portfolio. The same thing when I said I had no exposure to crypto. I had no exposure to Canada. I had none. I was like, because I wasn't that convicted in Canada. I was like, but I kind of wanted to get some exposure. I'm like, this is a good entry point for me. It was like, these are my only Canadian positions. I don't have an index fund holding Canada, me personally. Like my wife has a small thing, but me personally, I have nothing. I'm just full in on NASDAQ, S&P, individual stocks. Like I got all tech, like a lot of it. So like, that's how I operate. So I'm like, oh, cool. This will give me a very small exposure, but it'll be some exposure. Like there's that right off the bat. It's like, okay, how do I got to explain that to somebody? It's like not
Yeah, I
even so
mean,
much for not even for the tax benefits. It's for, like, I just wanted
yeah.
more exposure.
No, what you're saying is correct. Nobody should copy anyone else's. It's called do-it-yourself investing for a reason. It's
Yeah.
called personal finance for a reason. I never, I personally know people that just copy my portfolio. In a way,
Yeah.
I'm honored. They trust me. They believe in me and my thinking. But I always recommend not to do that. You do not copy anyone. You got to figure it out for yourself. And just like you're talking about HDIV and bank, and maybe I'll take the dividend from MSTE and put it in HBT. This is all decisions and thinking that you will automatically get with time and experience. And there's literally a billion ways to do it. Conviction in the US, let me get a bit of this. And convictions change over time. Like I bought a little bit of gold recently because I saw a video and I'm realizing, okay, central banks all around the world, like China, are buying gold like crazy. And if that continues, well, gold is going to go up. But I have my underlying foundational conviction is inflation. Asset prices will continue to go up, but that's a symptom. It's not that they keep going up and up and up. My grandmother's house that she bought for I don't know how much is now worth 600,000-700,000. Why did it do 10 times or whatever 20 times when it's much more crappy and ugly and decrepit and the plumbing's breaking down? It's because the dollar is worth less. So
Yeah.
as long as you're buying what you feel are quality assets and holding them for the long term, you'll that's what long-term investing is. Covered calls or not, leverage or not, index based or not, we're all kind of investing in the same thing. We're just getting our returns in a different way. And you go with a style that makes you feel comfortable. Growth, income, a hybrid like you. There's no right or wrong.
So now here's a couple questions. I want to hear your thoughts on this. So you know how you don't like short-term trading and that kind of, like, you're like, oh, it makes you like like when I was sort of mentioning it before, like, oh, like swing trading, short-term trading.
Doesn't mean,
There's
yeah,
one,
I mean, yeah.
but there's one thing I personally don't like. Maybe, I don't know if I don't like, it goes against my psychological profile. Is I don't like using when people use, or I would never at least use a credit line to buy a stock. I've heard and I want to talk about this. Someone said I bought 7,300 shares on my line of credit. I pay $450 a month in interest. I get over $4,000 in dividends. I can pay that money back within 2 years. Then I've got 7,300 free shares. Awesome video. That makes me nervous. I don't like it because then me personally, this is my perspective, I don't feel like that's responsible investing because you're now putting yourself in a position that if it did go to the hypothetical, everything collapsed, zero, and all stuff, you're not only holding the bucket, you owe somebody money. And
Yeah.
I'm like, I only personally like using money I have. It's another reason why, and I'm not against margin accounts. Like people have margin accounts. I think margin accounts are a lot better than a line of credit that you literally like. A lot of, I think people are using their home line credit, like when you're supposed to be buying a house with it. They were using that. I'm going, oh Jesus. Like for me, that makes my heart go like, I can't do that. I cannot. I need to know that if I lose my money, it ends with me. It ends with like it's out of my pocket. Oh, I'm just out the money, but I don't owe the bank nothing, right? What do you feel about that? I don't promote that. I think personally, please don't do that. Just don't invest any money you don't have that you personally can't lose because you don't want to be owing someone money at the end of it.
Yeah.
Can you talk to me about
I'm full agreement with you on that. I don't like the idea, but it's just me. I'm not against using margin, or I know some people that have used it very successfully.
yeah,
Obviously, sometimes it goes to disaster. Depends on a lot of things. How much are you using? What is your rate, et cetera, et cetera, et cetera. Obviously, the cheaper rates get, which we're getting there now, they're going to go cheaper. The more this becomes more and more popular. As a general rule of thumb, I personally don't like it. I just don't
yeah,
like borrowing money in general, to be honest with you, just in general. Obviously, house, mortgage, whatever, but that's margin, that's leverage. But, some people have done it really successfully within HELOC, and they got in they did it during COVID, so they had barely any interest to pay, 2-3%. They put it in the S&P or the Nasdaq, and hey, they just arbitrage the difference, and they've done really, really well. You could do really, really well, or you could get destroyed. I mean, you just never know. Personally, I don't take margin, but I'm comfortable with it because I invest in 25% leveraged funds. It's an amount that I'm comfortable with, 25. Now there's Evolve has come out with some 33.
33.
I'm
Yeah,
very comfortable with 33 as well. 25, 33, that's negligible. But why am I comfortable with it? Well, because first of all, it's not me borrowing the money. It's in the fund. They're never going to get margin called. All right. Now at 25 or 33, these are big,
yeah,
massive institutions that
yeah,
they manage 7-8 billion. Even if they're
yeah.
smaller institutions like Harvest and Evolve and Hamilton, they're all about the 7 to 10 billion AUM. They get much better interest rates than me or you. So again, just like you said, I don't feel comfortable. I don't endorse it. I feel the same way. Everyone needs to make their own decisions. Just be careful and understand what you're doing if you
Yeah.
are taking the margin. Personally, I'm not going to ever rule it out. Can I see, when I log into Questrade non-registered account, I see my buying power is like $1 million. Don't think I haven't been. It went through my mind. Well, let me just buy 100,000 more of this and this and this, and even if it's HYLD or QQCL, some boring stuff, I could do that. And if the S&P and the Nasdaq or whatever keeps going up 10-15% a year, it'll probably that's much higher than the rate I'm borrowing. But I don't know what the rate of borrowing is. I'm just saying it could be very tempting, but it's not something I I'm interested in or do or recommend, especially for like newer investors. If you're just trying to catch up, you think you're too late or you're starting late. That's typically a lot of people. They want to put fuel on the fire. It's just not worth it. You're gonna lose sleep over it. I
Yeah, it's
personally
tough.
wouldn't do it, but is it wrong to do it? No, there's no right or wrong when it comes to investing, I would say.
And to give people an idea of my psychological profile, I'm very debt averse. Like I'm hyper debt
Same,
averse.
same.
Like I got my hydro bill and my utility bills. Like you get it every month, and it was negative $600. I overpaid it. I went to the bank and they're like, I was doing some stuff over there, and they're like, why do you have negative like $4,000 on your credit card? I was like, oh, I don't know. I just overpaid. I just like because I don't want to like even look at it. I
That's
just
so
overpay it.
funny. I
Yeah.
literally have negative 2,600 on my credit card right now. I
Yes.
overpaid it by accident.
Yeah.
And it's great. I look at my credit card balance, minus 2,600. That's great.
Yeah.
I hate debt. I hate borrowing. When I
Same.
first started the channel, even before that, my wife and I had no debt, just a mortgage. We hated having a mortgage. We hated it. We
Yeah.
literally spent, this is back when we didn't know really much on investing. We spent all our disposable income throwing it at the mortgage, and we got rid of it in 7 years instead of 20 years. So
That's
that's
still
just
really
how
good though.
much I hate debt. So I'm with you. Obviously, you can't stand it either. So
Um, Here's a simple question, and you can just answer it. Is this dividend paid monthly, and can it be purchased into TFSA to avoid the tax? I get a lot of these beginner questions. And then also, is it eligible in Canada for your TFSA? It's yes, yes, yeah, yes for all of these. Right?
Sorry, I'm just sorry. I got distracted. What was the question?
It
Is it
says,
monthly?
is the dividend, this is a very, cause I got this beginner question a lot. Is this dividend paid monthly? Can it be purchased into TFSA to avoid the tax? Is it eligible for the
Yeah, yeah,
TFSA?
yeah.
Yeah.
All ETFs in Canada you could buy in the TFSA. They're all TFSA RSP eligible. The best place to, if you just go on every fund's website, you'll see TFSA RSP Lira eligible. So yeah, they're all eligible for all accounts in Canada. It is monthly. Some of them are semi-monthly now or bi-monthly. Two dividends a month. So you can look at all that information on the fund manager's website. But MSC for now is monthly.
One person said the NAV erosion alone will erode everything. This is all madness. I feel like we talked about that. How well we talked about even how distribution cut is trying to protect the NAV, and
Yeah,
why
I
that was a
made
good thing.
several videos about this topic. I think NAV erosion is a myth.
Yeah,
I think you just look at the total returns. People
yeah,
people that typically are yelling this NAV erosion crap, they're just looking at the stock prices. They're not looking at the total returns. Just looking
yeah.
at stock prices and not total returns is the epitome of a newbie in investing, right? You're literally
I
judging a book by its cover.
we both talked to. I saw you talk to Raj at Evolve too as well. I ended up talking to him not too long ago too. Smart guy. I liked him a lot. I when I was talking about what I'm like, why do people? Because I brought up the Ben Felix thing. I said, hey, did you watch that video like in our podcast? I was like, what did you think of that? Right? Because he's a fund. He owns covered calls. I'm like, what did you think of the Ben Felix calling covered calls the devil's bargain? And he's like, well, I
Yeah.
watched a bit of it. And then I was like, well, here I'm like, and I told him my perspective. I'm like, I don't get it. I don't get why people compare traditional index fund to a covered call. It's it's like one person's playing basketball, one person is playing soccer, and just because you're both playing a sport, you're comparing them to each other. They're different vehicles. They're used differently. You're looking at different metrics for success. I don't get why I'm like covered call ETFs should be compared against other covered call players. Other soccer players should be compared against other soccer players. Other basketball players should be compared against other basketball players, right? Other index funds. I don't get the crossover. My only rationale for why they do it is because I think a lot of people start with index funds. It's like that's how you like try to explain it to people. But in reality, it's two different vehicles with two different, like your total return is what you're looking at. I don't obsess so much about that price so much. I'm looking at total return. There's all these different factors you're looking at. Um, do you think like why do you think it is? I think it's personally because it just you got to explain it in some way for people to understand. Most people know what a typical index ETF is, so that's where you start. So you start making those comparisons, and that's where it gets muddled very quickly. At least that's how I feel about it.
Well, I mean, to measure the performance of a covered call ETF, for example, an S&P 500 or a Nasdaq 100 Nasdaq 100 covered call ETF, I will do the comparison to the index fund. I'm curious to see the performance and the total return. So, I'm an investor who wants the yield and the total return. I want both. And what I've discovered is that most likely, actually, I would say 99.9% of all covered call ETFs will underperform just holding the underlying asset without the covered call. And it's very, very, very simple and easy to understand why if you understand what a covered call strategy is. It literally means you're giving up upside, a portion of the upside of the underlying assets for those premiums, right? So if the stock market goes more up over time, which it does, of course you will underperform because the markets go more up over time. Plus the covered call ETFs also have higher fees, which eats into your total return as well. But in Canada, they discovered that if they add 25% leverage, and leverage is very cheap now, and when leverage is cheap, adding a little bit of leverage kind of gets you to similar performance. Not all the time. Sometimes you'll still underperform a bit. I've seen some that are outperforming right now versus a benchmark that you choose, whether it's the S&P. You're trying to choose the thing that's most correlated, right? It's very hard to compare Well, MSTE is easy. You just compare it to the performance of MSTR, right? That an
Yeah, yeah.
S&P 500, that's easy. You compare it to VFV. But some are a little bit harder to compare, like HHIS, for example, right? A collection of 19 innovation, mostly tech stocks. What do you compare that to? Well, you kind of have to compare it to an ETF that has those 19 stocks exactly weighted without the covered calls and everything. So it's a bit difficult. But HHIS is outperforming the NASDAQ 100 for now, right now,
Yeah,
right? So
yeah, but like but you're comparing total return though is what I mean.
total return, yeah,
People
which is
don't but no one's compared. That's when the uh comparisons get made, they don't do that though. They go like, hey, the nav went down or all this kind of stuff. They didn't. I'm like, no,
well,
total
that's
return.
nonsense. You're wasting your time.
Yeah,
I mean, it's
yeah,
why even bother? You have to total return is really the measure, the only measure of
yeah.
the performance of an ETF or a stock. It's not the stock price. It's the stock price and the income. It's the total return. That's a very classic mistake that I don't know why people keep doing. They shouldn't. The, the ultimate truth is always a total return. Now, if you, like I said, covered calls on a certain percentage, typically not more than 50 with 25%, there's like fund like HDIV, which is literally the OG, the original. If you do HDIV versus, well, HDIV is also very hard to compare because it's like 70% Canada, 30% US, right? So it's like you could compare it to XIU, you could compare it to VFV, but it's not exactly correlated. But guess what? HDIV is outperforming both of those index funds right now. What does that mean? Well, that means if you would have bought VFV or HDIV and held it for the last 3 years, you bought them at the exact same time, put 10 grand in each, you would have more money or more return with HDIV. So a lot of
I've
people don't know that. You got to look at the total returns, right?
I ran so many models of HDiv in my non-red. You just run all these simulations of like how this will perform after 10, 20 years, depending on distribution rates and stuff. One
Yeah,
thing that I like, I'm just gonna use HDiv as well because that's what I'm buying. I like for my non-registered the fact that I feel very confident I never will have a reason to sell it, which means
yeah,
in 30 years, I'm just going to turn off that drip that I have on because there's going to be a drip on
exactly.
it.
Yeah,
And then I'm like, great, that's it. And then it's tax efficient, right? Depending on what my income is, right? I'll get Canadian eligible dividends on some of it. Then I get that, deferred ROC, all that cool stuff that comes along. I have all that because on my non-reg. That's great. Rather than me, like, why don't I just buy the Canadian equivalent or buy like a VFV in my non-reg? It's like, okay, I gotta sell this thing, get taxed on it. Like there's a whole bunch of. I'm like, that's why I like holding it in my. Actually, I like holding VFV and all them in my registered accounts, is because then I can sell it, take all that, and then convert it within my TFSA
yeah.
into covered call. Like, and then I don't have to deal with all that messiness, right? And then for me, it's also cool because I'll have a 20-year case study. I wonder which one actually performed better, right? They'll probably come out about the same, is what I'm assuming. It'll be like roughly the same, but at least
It'll
for
be
me,
very correlated. Yeah,
it'll be really close. But for me, it'd be kind of cool because I have an advertising background. I like tests. I love split tests. That's why I test so much on my channel. Like psychological profile, by the way, guys. I'm very clear about this on my channel. I do a lot of decisions because I just want to see what happens. I just want to make a YouTube video about it. And I just want to go like, ooh, cool, look what happened. I did something good or bad here. That's my brain, how it operates. So another thing to consider. But yeah, so I have very distinct now, I'm creating it, profiles. I have like a non-registered covered call, and I have a registered index fund single stock kind of profile. And I'm assuming they'll perform about the same, but for non-registered, I'm sort of pre-thinking this, and you're the one who kind of got me thinking about this. Was I don't really want to think of that headache of taxes in 30 years. I kind of like just having HDIV or bank or whatever else is sitting there and be
yeah.
like,
You're
cool.
you're kind of yeah. So there's two things. There's two problems that holding an HDIV versus a VFV solves. VFV, you're going to have to sell it at one point to realize any gains. So that's a problem. Like you said, when you actually want to start drawing the income or using a portion of it, you just turn the drip off, right? Problem solved. Also, if you hold HDIV in a non-registered account, you're basically paying the taxes already on the distributions every year. like right
Yep.
away. So you kind of don't have to worry about paying as much taxes later on. Of course, if you're up and you sell it, then you're going to have to pay whatever. But your capital gains are definitely not going to be as high as a VFV because HDIV will never appreciate as much as a VFV in terms of capital because you're most of the returns are coming from the income. But if you're reinvesting, the total return's the same.
Yeah.
Right, as a VFV when you sell it at the end. So HDIV is actually very tax efficient because, or all covered call ETFs are, because call premiums in Canada are considered classified as capital gains. So you'll get either capital gains and or ROC income. Right, ROC I consider under the same tax umbrella as capital gains. It's just delayed capital gains when you sell.
Yep.
That's all ROC is. So capital gains ROC, very tax efficient in Canada, 50% more tax efficient than regular income, salary income, rental income. And in higher tax brackets, not a lot of people know this, it's even more tax efficient than Canadian eligible dividends.
Yep.
Yeah, if you're making more than $150,000 a year, capital gains and ROC are taxed much better than eligible dividends in most provinces. You got to look at your province's exact tax bracket. Eligible dividends are really taxed amazing in a low tax bracket. But once you go past 100, 120, 140, if you look, capital gains are actually better than eligible dividends, which means HDIV will always have some eligible dividends because it has a lot of Canadian dividend stocks in there. So it typically has 15 to 20% of its income is considered eligible Canadian dividends. The rest is the majority of the rest is capital gains and ROC. So very tax efficient as well. And like you said, there's no right or wrong way. You could, this account, I'm going to put this account, I'm going to use it for that. Some people do the opposite of what you said. I'm going to put the income stuff in the TFSA and I'll generate a lot of tax-free income because it's all tax-free in the TFSA, right? So there's no right or wrong. You could associate one account for your growth, one account for income, do a hybrid. So yeah, there, like, again, we keep saying it, but there's no right or wrong way. You just invest the way that makes
Yeah.
you feel better.
Yeah. I specifically just didn't want to deal with the headache of selling a bunch of stuff in my non-registered. So
That's
it was just solving for me
That's a
personally.
big problem income investing solves. A big problem that's very underappreciated, undervalued, that a lot of these growth bros they don't get. I never have to really sell anything. If you think about it, I can. I'm not saying you don't have to, but I don't see myself ever selling my MSTE or my HYLD. Well, why would I need to sell it? It's generating consistent income for me. I'll do whatever I want with the income. If I need it, I'll spend it. If I need half of it, I'll spend half of it and reinvest it. If I don't need any of it, I'll reinvest all of it, right? You have the flexibility every month. With the growth, you don't really have much flexibility. You're going to have to either sell some units every month if you want to draw down or you need some income. You're going to have to sell at one point, right? So that's just
My
personally
plan,
what I like. One of the psychological things I like about this strategy, the income strategy in general.
my plan is to never hold stuff or try not to, like, obviously this is, I can't say never, but is to not hold anything in my non-registered that's covered call that I have to sell other than my initial rebalancing. That I'm only doing a rebalancing right now. The only reason why I'm deciding to sell MSTE a bit when it hits a certain price more than what I paid for is because I just want to buy more HBTE to balance out that 50-50 portion. I just want to get them both at 50-50.
To me,
then I want to walk away.
Yeah. No, to me, you're not selling it to realize a loss or a gain. You're not trying to flip it. You're doing it in a way to rebalance your portfolio. Like myself, I've sold some stuff and but it's mostly it's not to buy low and sell high. I'm still a buy and hold investor. It's just to rebalance, or maybe a new fund comes out that you really, really like, or maybe your tax situation changes, or your conviction changes. You could rebalance and sell stuff to rebalance. It's not that you're buying low and selling high.
It'll be as simple as this. It'll be whatever my MST position comes out to. It'll now only go up, basically based off of my monthly distributions off that thing I told you. Like, oh, great. Now I'm at 50%. Oh, MST dropped. Okay, maybe I'm going to buy more of it. Now it's at 55%, 45. Oh, HBT dropped a bit. I'll use next month's distribution to bring it bump it. And I'll just be bumping it up and down. percentages, but not the size based off distribution. That's it. And then HDiv on overflow, when they're both performing well, I'm going to dump into HDiv because I'm like, I'll wait for them both to drop. I want to build up more HDiv, or maybe I just want to build up more HDiv. I'll pivot it there for a while. Like that's all I'm doing now, using distributions to keep building up and allocating percentages. That's it. That's a strategy. I really don't want to have to sell after this one and only sell I'll really be doing once it hits a certain price. That's it. Because I just want to get that 50-50. When I look at your like nobody copy you, a couple things that they should copy is, I think, is your decision-making process. You're open about, I'm buying this because of this, I'm buying this because of this. People need to inherit that methodology of you're like, I'm in Panama, I do this for a tax rate. Like you're an example of the hyper personalization that I talked about. People need to take that from your channel, being like, oh, okay, wait a second, this is why he's buying these positions. There's a couple things that I agree with you psychologically. I do have the same approach as you, as simple is best. You know, there's a lot of people with like 50 positions and like 40. I'm like, man, I got a lot going on, and I just don't want to think of like 80 positions and constantly buying and selling. I'm like, I want as little overlap as possible. I want, just give me a couple good positions that I can just like have there and build them up. But that's me personally. A lot of people I've spoken to on the podcast, they actually just like buying and selling and moving. Like that's more their psychological profile.
Some people like to be more active.
Yeah,
right?
if they're not performing worse, they might be performing better. Who knows? I'll perform slightly less better, not as good, just because I don't feel like doing that. Like, but it's like me. So like that's like after watch your channel, talking to you, I'm like, yeah, I'm with you on that one. We have the same approach to debt. We do keep it simple, you know, like stuff like that.
Yeah, I mean, there's no right or wrong. Like I value my time tremendously. When you become, and you know, you're a wealthy guy, so I could ask you about this. When you as you're getting older, you're realizing, what do you realize the most important thing is? It's time.
Time.
The more wealthy and older you get, that's the most important thing. So for me, it's important. I don't want to spend as much time. I do it once a month. All my dividends come in once a month. I typically decide, okay, it's very rare that I'll do a pop-up investment of $5,000. It's possible, but it's very rare. I typically, when I know all my dividends for the month, now it's a bit annoying because there's like semi-monthly. So what I do is I leave the second set just sit there in cash, and then I'll reinvest it when the first set comes in. That's how much time is important to me. I don't want to spend the 60 seconds to log in and reinvest, but that's just me. Some people like to have fun with it. They're actually enjoying it. Like, for example, Perry's PII verse. He's a PII cover call investor. He likes to have fun with it and do analysis, and he's got his Excel sheets, and that's great if you enjoy it. And he was an IT architect, so I understand why he likes doing it. Personally, I'm not going to do too much details. I'm more like you. Let me select a few anchors, core, basic, strong positions, my portfolio. That would, for me, it's like an HYLD, a QQCL, right? An S&P, a NASDAQ 100. For me, that's boring. That's just boring. Indexes are so boring because it automatically selects the top companies. If one falls out of favor, you don't have to worry that it'll change in the index if a new company's coming up. And you know what I mean? So, but MST for me is more, I'll spend time looking at the dashboard and looking at Saylor because it's entertainment for me. I have conviction and I like listening to him, and I share his philosophy about a lot of things. So it's interesting to me. So that's why it's always do-it-yourself investing. How much time you take to manage your portfolio is really up to you. Some people don't want to spend any time. Some people like spending and looking at it every day. Some people once or twice a month, like me, maybe. And you know, to each their own. There's no right or wrong way of doing it.
I'm going to ask you a few more questions. How long do I have you for? I don't think I got you for much longer, right?
Maybe another 5-10 minutes or something.
Okay, perfect. People ask me questions about you, or they leave comments about you on my channel constantly. So whenever I talk about cover call, all the time.
I don't know why people, they're so fascinated, talk about me all the time.
It's all good stuff though. Luckily, a lot of it's just like, hey, do you know what he's up to here? You know, if I say something to be like, oh, Adriano said this, which is, it's nice, it's good. And I'll basically, off of people's questions, I had two things that kept popping up. One was, You sold your USCL position. Here are his positions: HYLD, QQCL, QDAY, HHIS, Big E, MSTE, HBTE, HBIX, GLCL, CLSA, and ETHY. Those are your positions, but your core US positions are HYLD. But you used to have HYLD and USCL. Question I get from people is, why did he sell? They're asking me why you sold. Well,
Yeah.
I don't
Well,
know why you sold.
in every
But
portfolio unveil, I go into detail on why I do everything. Not because I want people to copy me, because I think they deserve to know my reasoning of why I do things, like we discussed. The honest, it's I didn't need it anymore. That's just the reason. There's a lot of overlap. There's becoming more and more overlap with the S&P 500 and the Nasdaq 100. There's like over 50% overlap. I had HYLD, I had USCL. The main difference between them is USCL is the actual S&P, HYLD is maybe a little concentrated version. USCL is not hedged to the Canadian dollar, HYLD is hedged to the Canadian dollar. I just decided I was up on it. I could just trim it and have a smaller, more lean portfolio. That's really the reason why. There's nothing
yeah,
wrong with USCL at all. It's still performing very similarly to VFV. It's underperforming a little bit with dividends reinvested, but it's doing its job. And to me, it's just like now as I get older, I don't know, my convictions are getting a bit stronger, and the S&P 500 is actually pretty boring to me. It's actually pretty boring. Like, I'd rather go with the Nasdaq. Maybe I'm personally comfortable with more the Nasdaq 100 being an anchor because I believe in the technology. It's more a little bit more concentrated in technology. But you look every day, and the S&P and the Nasdaq, they always follow each other. So they're so correlated. So for me, it's like, let me just trim this one. It's
and
just as
then
simple as that.
one other one. I think you had, was it like S-Day before, and then you got
SD,
rid of
same
it.
thing. SD, I trimmed it because it
But
got
it's
added
in
to
HY.
HYLD.
Yeah, like
Right, so
uh,
that's another trim I did, and maybe I'll do another trim later on. I don't know. I mean, who knows, right? It's
there's,
just,
I think C days in HDiv as
yeah, it
well. I
is.
think I'll, because like I remember when I was looking, I'm like, oh, maybe I'll get C day, and I had before I bought it, and I was like, no, because it's already in HDiv,
Exactly.
and I was like,
But
I
you
just
could.
don't want to.
There's nothing wrong with having both, or there. C Day is, I think, 25 Canadian dividend aristocrat stocks.
Yeah,
They have a very, very unique cover call strategy there where they're doing zero DT cover calls on the
like
S&P 500, and
yeah,
there's no cover calls on the Canadian stocks. It's very interesting, very, very innovative. I really like it.
I like
But
it too. Yeah,
HDiv is more wide, more diversified, and I guess you could say less concentrated or maybe less risky than C-Day. But even risk is in the eye of the beholder. Some people just, they want C-Day because they want more Canadian exposure, or some people are more comfortable with HHIC or CANI because they're comfortable with even more concentrated Canada, or the 9.1 ECHI, right? They have 10 stocks. CDAY has 25. HDIV has Canada, mostly Canada and the US, but let's just say more. So there's a lot of overlap between this stuff. It's really up to you. A lot of new people have this question for me: why isn't this in your portfolio? Why are you getting this one? A new fund comes on, it looks great, and now they had to buy it, and now you're stuck after a few months or after a few years. You got like 30, 40 positions with a lot of overlap between. There's nothing wrong with that, but like we
yeah,
talked about before, I like a leaner portfolio, and that's basically it. There's no right or wrong on how many ETFs you choose. Some people like to collect them like Pokemon. They just like having all of them. That's
yeah,
completely fine too. But there's just more to manage, and every month you're gonna have to make more decisions in terms of where you're reallocating your dividends, if you are reallocating dividends. Myself personally, I like having it more lean, so I have 5 core positions for my US exposure right now, 3 for Bitcoin, and then I have a couple of other little small ones, and that's it. I'm happy with that.
Yeah, I'm the same with you. Like I like to keep it really lean. And even when I'm looking at HDIV, I think it's don't quote me on this, like 9% of it is now C day. And don't like probably around that, maybe
About
seven
10,
to
yeah,
nine.
something like that. Yeah.
And I was like, well, if I'm trying to build this into a massive position, let's say that's turn it into like $100,000 position or something. Yeah, that's solid. That's like a $7,000 to $10,000
Yeah.
position in C day, which would probably be the allocation anyways. And I wasn't buying it for the twice a month payments. I was buying it because I like the 20% on the S&P and the 80% is collecting it. I just like the model because I thought that was interesting. I'm like, oh, cool. They have great 10% of that model will be used. I'm like, that's all I wanted. So I'm like,
Yeah.
yeah, like
And
I'm cool with that
that's
allocation.
always that what you just described is why you should invest in things
Yes.
or in
Yeah.
this or in that because you like the model, the first thing you have to like are the holdings. That's number one.
Yeah.
Number
Yeah.
two is the strategy and the model, like you say, very innovative, the Daymax model from Hamilton, right? Do you
Yeah.
love it so much that you'll get it separate, or are you okay with having HDIV and HYLD, which includes that now? There's no right or wrong with this, right? It really depends on your conviction and what you like, and that's pretty much it. So yeah,
I th-
and there's gonna
I
be
think
more coming. You know, there's gonna be more new stuff coming. And should I buy this? And I get the question all the time. Well, why don't you have HDIV? It's so good. I always talk good about it. It is really good. Why don't you have it? Well, I have a conviction more in the US, kind of like
Yep.
you.
Yep.
Also, I my tax situation is very unique as a non-resident. I actually want
Yeah.
to most of my money is in the non-registered regular account, and I actually don't want any Canadian eligible dividends. I only want capital gains in ROC because I get that refunded.
Yeah.
So I could put HDIV in my TFSAs, and maybe I will do it. I'm not sure,
Yeah.
right? So there's different factors for different people, but the important thing is for you to figure out what are you comfortable with what's best for you depending on your province, tax bracket, tax situation, convictions, where you're at in life, et cetera, right? Stability versus a little bit more, maybe a little bit more risk and a little bit more yield,
Yeah.
right? S&P 500, a little bit more. NASDAQ 100, a little bit more. HHIS, a little bit more. Biggie, right? You're,
Yeah.
you're, you're getting a higher yield and taking slightly higher risk with each one of them. But again, risk is still in the eye of the beholder. What's more important to you, getting a bit higher yield and more concentration in tech because you're convicted and you want more higher yield, or is stability more important for you and you go more with the HYLD, HDIV, VFV, cover call or not, it's the same deal, right?
One last note and let you go. I forgot to mention I do own Biggie as well. I have $25,000, and that's actually in my registered account. I have it in my TFSA, and that's just sort of there. Cool to have it. It's US. So and second note is the expense ratios, the management fees on covered calls. I see it like this. I don't want to write them myself. That's just me paying my employees a percentage so they can manage
Yeah,
covered calls for like that's how my
they're
brain
so
sees it.
low too, right? I I,
I
I
don't
see
time. It's like for me, that's worth it. I don't have to do that
time.
myself. I'm paying you
Exactly.
to do it for me. That's how I see it in my brain. I'm like,
Just
perfect.
recently, I'm
Yeah.
I'm with you. Sorry to interrupt. We have a bit of a lag, so I'm not doing it on purpose. A lot of people always say, hey, you're interrupting. We're not doing it on purpose. I'm in Panama. You're in wherever you are, Canada or whatever.
Yeah. Yeah.
So it's so funny. I've been seeing this on Blossom. Oh, what's the point of paying the management fee? You could just buy the stocks and write your own calls. Are you crazy? Are you nuts? I don't have time to do that. That's not
Not
how
even
I want to
close.
spend my time. You think
Yeah.
I'm gonna write calls better than professionals who that's all they do, who get better borrowing costs? All these funds are leveraged as well.
Yeah.
I visited Harvest ETFs. I
Yeah.
visited their trading room, and I've sat down with Paul McDonald,
Yeah.
who is their head options guy, and I told him, can you just run me through what you guys do in 1 month for the MSTE and MSTY ETF? Sat down, I sat next to him, he showed me. These guys are tracking it every day. They have spreadsheets, they have graphs, they're calling the market makers to make sure, like, do you have any? I'm not going to do better than him. Are
Yeah.
you like, I, the argument is like, well, why go to a high-end restaurant when you could just have a burger at home? Because I don't want to spend time. Why are you judging me for the way I live my
Yeah.
life, the way I invest?
Yeah.
I don't understand that. Of course, I know I could buy the stocks and write my own cover calls, but I'm not going to do better than them. Like,
Yeah.
I don't want to track it and look at it and buy it. I don't even have options trading enabled in my account. Just thinking about it gives me anxiety. I don't want to deal with that. You're paying for a service just like everything else. I could clean my own house, but I pay someone to do it because I don't want to spend the time doing it. So it's like
Yeah. Same.
40
Same.
basis points. HHIS,
I'm.
MSTE, 40 basis points. HDIV 65. You know what that is? That's like
Yeah.
$6.50 for every $1,000, is it?
Yeah.
Is it that? 0.65. Yeah, it's $6.50 for every $1,000. So if I just calculate, for example, I have $600,000 of HHIS, okay? It's my biggest position. They have zero point 0.4. I pay $2,400 a year to have a professional portfolio manager manage all the calls on those 19 stocks, handle the leverage, give me my monthly distribution. It shows up every month, and it's only going to cost me $2,400 a month. That's
That's
fantastic to me. That's like
for
such a
for
great
for
deal.
me. That's for the amount of work being done. That's just a notch above slave labor at the prices you're getting it at. It's like
Just above
great.
it.
You can't get. Yeah, it's like you can't get it like for the amount of stuff. Like you said, we do not have enough time in our lives to learn that skill set as efficiently as that
People
team.
think it's easy.
We could
It's
never
not
get good
easy.
enough. We couldn't get good
Yeah,
enough. We just
it's
don't have
not
enough time to
easy.
get good enough.
They
Um,
so they think they're just gonna write one. They think on Harvest just writes one call a month. No, they
yeah,
don't. They have
yeah,
several legs. They track it. They monitor. You got to roll the call. You got to buy. There's so much goes into it. When I asked him, Paul, show me your process just for one ticker, it was like 30, 45 minutes long. I understood maybe 30% of what he told me. There's so much that goes into it. These guys are literally looking at this stuff every day. Um, to me, it's very cheap. Like you said, I agree with you. What you're paying, well,
yeah.
let's not say it too much because we don't want them to raise the management fees. But
Yeah, there you go.
to me, it's
Um,
well worth it, right?
100%. Like I know the work that goes into it. It's fine. Like I said, I feel like I'm just paying employees to write calls for me. I have employees. I pay them a lot more than what I'm paying Harvest. Right. So for
Right.
me, it is it's a
Or a
fine trade
financial
off
advisor,
or
but
financial. Yes,
let
good point.
that's a topic for another another
That's another
controversial
thing.
topic for another time. You know.
All right, Adriano, thank you for your time. So basically, in summary, MSTE, why do we own it? It's a high conviction stock. We believe in the underlying asset, MicroStrategy. You can just think of MSTE as MicroStrategy. That's what it is. We did not worry too much about the distribution drop. It just, to both of us, looked like Harvest was responsible, had a long time horizon. It was just protecting the NAV to make sure it doesn't, we're just protecting the overall NAV of the
The integrity of the
stock.
fund. They don't want to
The,
overpay.
yes, the,
And if you're investing in that, you got to believe in Bitcoin. You have to believe in what MSTR is doing. Same reason you would buy a Tesla. You got to believe in Musk and what he's doing. If you don't have really much conviction in anything, just buy the indexes. Right? To me,
yes.
if you have no conviction, you're going to buy an index because you're going to be like, let the best win. Let my money go to the best company. That's what an market cap weighted index does, right?
Yeah.
It's Nvidia's number one. Maybe next year Apple's going to go back to number one, or there's going to be maybe Palantir will go number one, or maybe Strategy will go number one. You just don't know. You just
Yeah.
don't know, right? So if you have no conviction, stick with the indexes. But conviction comes with time, experience as an investor, and my convictions shouldn't be your convictions. You should each have your own. But what I will tell you about MST is that I will keep buying at least $5,000 every single month until at least I'm broken even on it in terms of capital. If I could average it down, I'll average it down, and then we'll see what happens later on.
Yeah.
We'll see what the plan is, but at these prices, I'm going to keep buying at least 5 to 10K every single month. But I could afford that. I could afford to lose that, right? It's
Yeah.
still going to be a small 10% position in my portfolio. To me, that's okay. Don't borrow or against your house and gamble
Yeah.
your kid's college fund to buy MSTE or MSTE. That's just crazy to me, right? So be responsible, take responsibility for your own investing actions, right? Don't just do what I do or what Gary does. Do what you feel is comfortable for you, and yeah, I mean it. If if you can't sleep at night, if you're losing sleep over it, then maybe it wasn't a good idea. I wouldn't say just sell and rip the band-aid off, but maybe you could start doing the feeder strategy like you, to start reducing your percentage to MSTE or whatever else you feel you're too high on. There's several strategies you could do. And don't forget that in a non-registered, losses could always be carried forward forever. So I
Yeah.
always tell people, quick tip here, if you want to take a little bit of a more of a risky investment, do it in your non-registered. Don't do it in your TFSA or RSP, because you lose the room and you can't do anything with the losses. So
Yeah, I have quite a few options here of how I can manage this position. I'm not too worried about it. All right, that's that, guys. Okay, make sure you check out Adriano's channel. It's in the first pin comment and the description. Leave your comments below on what did you think about what we talked about today, and do you own MSTE? Will you own it? I just want to hear your thoughts in the comments. Let us know. But make sure you check out his channel. Go to passiveincomeinvesting.ca as well. I always check out the monthly breakdown. Tons of great information there. Adriano, thank you again for being on with me, brother, and
always
we'll
fun
talk
doing
soon.
this, man. We'll do it again.
Yeah, talk soon. Bye.
Take care, Gary.